And as I mentioned, we have an interesting presentation by Don, who will be taking a look at 10 balanced premium SectorSurfer portfolio strategies. I originally met Don a few years ago at Lockheed Martin, retired investment group for Lockheed Martin retirees, and they have a very good group. I've been very pleased that I could be a member of that. Although Don is a new member, he's really jumped in with both feet, and I feel he's doing an excellent job. So let's see what Don has to say. Don, come on up.
Thank you, Joe, for the introduction. I jumped into SectorSurfer because I saw a lot of things, a lot of techniques in SectorSurfer that I've been using in my own private strategy for investing, namely the idea of rotating into a new sector as it becomes in favor and rotating back out. And so I welcome the idea that this could be done for me automatically. Right now I spend hours and hours. I download something weekly, monthly, and then I put it into spreadsheets and then evaluate it and say, okay, it's time to sell gold, for example, and buy biotech. Just throwing those out as examples. So if I can go to the next slide, I start off with a review of pretty much what I told our Lockheed Investors Group, Retirees Investors Group. SectorSurfer demonstrates the effect of rotation of the best trending mutual fund, ETF, or stock. Trade alerts are sent and to rotate. And they come very reliable. I'm very impressed with that. You know, you get it in time to make the trade the following day. I like the idea of compounding of profits. Total dollars from previous sell applied to the next buy. It's very attractive. I've not done a lot of compounding myself, but with the SectorSurfer portfolios I have now, I'm doing automatic compounding. And the big thing, which also I've been doing for years, and switching to cash during market downturns, which reduces the risk of loss in the market. We all know we got hit real hard in the 2000 .com bust for several years. Then again in 2007-8, part of 9 for the financial crisis. Those were times to be in cash. And actually, if you look at your portfolio list, you'll see that, particularly in the earlier years when we were still getting money markets at 4 or 5%, that shows up when he goes to cash. It's not everything he put into just a holding. It's just he's putting it into cash. Next, please. There are some issues with strategies. Avoid cherry-picked assets to generate a good score. I have to feel that the foreign country one is a little bit cherry-picked because that was shown earlier here. Like I said, there were about 25 foreign countries way back. How do you pick those 25? Did you pick them back in 1997, or did you pick them in 2013? That's the issue I have with cherry picking. Because today's cherries may become tomorrow's rotten apples. Avoid groups of assets that rise and fall together. I was trying some, in my sandbox of studies that I do, I did some studies and I picked 12 assets that were, turned out they all did great. They all rose together at the same time though. The overall performance over years was horrible. So I said, okay, I can't be doing that. I have to pick a group of assets that don't relate to each other in the economic cycle. And then avoid mixing of ETF stocks and mutual funds in the same strategy. If you put stocks into ETF or mutual funds, and like Joe said, the stock will tend to dominate. And you'll be in that stock almost all the whole time. It's very volatile, and also what you'll find sometimes is by the time it's so volatile that by the algorithm is such that by the time it's ready to sell, it's already lost 20–30%. So it's good to avoid this kind of mix. Okay, next slide, please. So I signed up for a trial, premium strategy trials, and I'll probably make it permanent as time goes on. Why 10 strategies, though? Problem is, I've got some examples coming up, but a single strategy has a reasonable probability to have a down year. I don't like down years like anybody, but if you just have one strategy, the odds are you might have a down year. So at about 5 strategies, and I think that Scott points this out in his explanations, the risk of a single year's overall loss is reduced when you get to about 5 strategies. And then the reason why I have 10, though, it takes at least 4 strategies to cover most all of the sector categories. Unless you want to cherry pick sectors, or at least pick sectors that you know are not in the same economic cycle as each other, it takes quite a few strategies to cover them all. So moving on to the first 4 strategies. First 4 strategies I have. Fidelity sector funds provide diversification of sectors. I've been trading Fidelity sectors for years using my own personal past methodology. Economic cycles favor different sectors at different times. Although, there's a few sectors that go together, energy service and energy, for example. Those kind of go together. By selecting them all in strategies, there's no gaming of the selections, as all Fidelity Select funds are held. That was something I really feel good about, having all sectors covered. And then the 5 through 7 strategies are ETF sectors, similar to Fidelity sectors. Now, in some years, the ETFs will actually outperform managed mutual funds. We've seen that within our own Lockheed Martin Retirees Group. We have a mutual fund portfolio that we follow every year. But for many years, we were noticing that the ETF equivalent was beating it year after year until just recently. Managed funds seem to be back in vogue again. And part of the reason was fees, management fees. ETFs having very low management fees are able to, and you can see this throughout the year as mutual funds take out their management fees. Gradually, the ETFs will catch up to the mutual funds and actually maybe pass them in some cases. Strategy 8, I wanted a broad group of large, mid, small cap, just to cover the time periods when when one of these asset classes would be outperforming. And also I wanted to include some international ETFs, so there's a group of 12 here. Strategy 9 is actually my favorite, but combines 2x leveraged ETFs with 1x unleveraged, what I call boom or bust ETFs. And you'll see that in upcoming slide, what I mean by boom or bust. Strategy 10, which is something I've been doing for years in a little small IRA that I have, is a mix of income-oriented Fidelity funds, including bond funds. It's a very low-risk strategy, but it turns out it can save the day in a downturn. Okay, here's some of the details of strategy number 1. I simply start with an almost alphabetic listing of fidelity sectors. So strategy number 1 has the first 10 fidelity sectors alphabetically. Strategy number 2 has the next 10 and so forth. It turns out it's almost alphabetical because I have, when I do some typing, I have a little dyslexia, I think. And this should have been FSCHX, which would have been, I think one of the chemicals, it would have been chemicals. So somehow we got medical delivery. But it wasn't, medical delivery wasn't put in there for anything other than it was an accident. Okay, moving on. Okay, here's the SectorSurfer chart. A couple things to note, as Joe has pointed out. Rotating the cash, 2002, 2008, very nice. Yet, if you look in those same years, the sectors themselves performed horribly. 2002, 2008 time frame. But because we rotated the cash, we were able to continue moving forward. So we end up with a lower risk of a large loss compared to the S&P 500. 3.5% versus 22+% for probability of a loss. And improved average gain, 25% per year versus 10% per year. So, and the yellow indicates again that the strategy is beating the white, which is the S&P 500 consistently. So, and this is just an alphabetical listing. And the other 3 strategies in the fidelity sector look about the same. Some do better than the others, but essentially they're picked. And I can pick these because I can feel comfortable. I don't have to worry about the fact that one sector is going to be out because it'll be taken care of by the algorithms, and it's not cherry picking.
How are you allocating your money to these various strategies?
I started out with equal amounts of money, and I implemented it actually only in May because it finished developing in that time frame. But I put equal amounts into each, and some have performed better than the others. To see that chart. Okay, strategy number 9, which is the old saying, there's always a bull market somewhere. I don't know, some investment advice I read years ago, whether it be U.S. stocks, international stocks, bonds, or gold. So, and I created a list of ETFs which do cycle through a changing economy. So we have bonds are represented by IEF, which is a 1x, but I coupled that with also a 2x 7 to 10 year treasury ETF. Gold was also in the always a bull market. Gold 1x, GLB, and then the 2x version is UGL. And then the market, S&P 500 large cap here represents a major part of the market. IVV, a VIX, and SSO for the 2x version. And then for the Russell 2K, which is small cap. So I got large cap and small cap. IWN for the 1x Russell and UWM for the 2x. And then internationals are represented by EFA, International Index, and EFO 2x. And then to fill out the 12 available slots, I threw in a single sector, banking, 1x, and KRU 2x. If you look at banking stocks, they do go up and down with the economy. probably close as I get to curve fitting, picking this one, because I looked at multiple sectors. It turns out there's one or two that are better than this, but I kept it at banking. And it turns out that that's done very well. Okay, let's move on.
What's the logic for the one times leverage on the upside and 2 times leverage on the downside?
No, it's 2x on the upside. They're both together.
Oh, is it?
Yeah, there's no downside here. I haven't had much luck with incorporating downside ETS.
Oh, so it's 1 and 2 on the upside.
Yeah.
Okay.
Don, wouldn't it always tend to pick the 2x leveraged version?
Not always, but it tends to. You probably can see this here. Here's a 2x, regional bank. No, it's when it's in a area where we're just coming out of a recovery, or if we're in a kind of a stagnant time period, the 1x would be favored. But you raised a good point. The performance pretty much shows that the selections have been 2x, at least this year.
Well, if these are literally 2x, and 1x, right?
Right.
Then they have to move in parallel. So that means that other than random noise, if it's going to choose one, it's going to pick the 2x. And how else is it going to do? Right? The 1x is never going to be better than the 2x.
It sometimes is for a short time,
Well, yeah, like I said,
and then
for sure.
2x catches up and passes it.
Yeah, so like I said, other than slippage with the 2x, because the 2x generally are a mess, right, with slippage and all that. But generally speaking, if it's gonna catch that sector going up, and they literally are correlated, it'll just pick the one that's going up the strongest.
Well, I did compare this in my sandbox with just a 2x strategy, and this does better than all 2x strategy.
Yeah,
What
but
I
it just
thought.
is, it's also a different model, so, right,
It's just an interesting concept that we're throwing out there, and it does work. And you'll see shortly that since, I think it's almost like 10 years, this strategy's done better than all the other strategies that I have without a single losing year, by the way. Okay, let's move on.
Maybe it could be because the algorithm's choosing the 1x can end up bear market sooner than the 2x. Because the 2x has a greater loss and takes longer to show up as a winner.
It does. That's a good point.
So it's getting into the 1x's earlier, and then eventually the 2x's will catch up and it'll grab the 2x.
I think that's a good explanation. I wish I would have thought that myself. Thank you. Okay, now this is one of 10 fidelity income-oriented mutual funds. It's a Spartan Intermediate Treasury Bond and Spartan Long-Term Treasury Bond. These, particularly number 2 here, can really perform quite well during the financial crisis and the dot-com crisis. There's Fidelity Balanced, which has a balance between stocks and bonds. Convertible Security, which has an income portion, government income, inflation protection. Fidelity has a series of asset manager funds, and I picked 20%. I think 40% might have worked as well. Mortgage securities, investment grade bonds, strategic income, which is kind of a mixture of bonds and treasuries, and then finally a utilities fund. And this is it's reasonably done pretty well. When you see the charts over time, you can see every year this strategy. I mean, people say, well, why invest in bond funds? Well, if you have bond funds at the right time of the economic cycle, you're going to be doing quite well. the safety rating for this is 105, has a very high safety rating. I can't say that its performance is like 14% per year, I think it shows there. It doesn't match some of the others, but again, it fits in with my total scheme of having a strategy that's going to do positive when all the other strategies